Hello, and welcome to the May Market Update webinar. My name is Dan White, one of ARK's Associate Portfolio Managers, and I will be moderating today's call. This call was pre-recorded on May 9th, 2025. With that, I will now hand it over to ARK's CEO and CIO, Cathie Wood. Cathie?
Okay, thank you, Dan. A quick macro market update. And for a more complete discussion, please go to In the Know, which I recorded last Friday. But what I highlighted in that webinar and in a recent letter that I wrote was that we appear to be at the tail end of what we have been calling a rolling recession for the last 3 years, ever since the Fed jacked rates up. And you can see in charts the recession in sector by sector, starting with housing, which has never recovered, and then going through small business, manufacturing, and then the sentiment indicators of consumers. Now, if you look at lower and middle income consumers, their sentiment hasn't been this low since 08-09. What has been holding the economy up, the reason GDP kept going, was, and to some extent employment, was high-end consumer and government spending. And both of those, we believe, are giving way right now. Consumer sentiment for high-income earners dropped to the levels of low and middle-income earners, probably because of all of the chaos around tariffs and how that impacted the stock market. And then, of course, government is in its first recession since the early 90s, when Bill Clinton and Newt Gingrich really focused on adding efficiencies to the government. And we ended up with a surplus, actually, in the 90s. So those two sectors are giving way. But we do believe that we're coming out of the rolling recession, and that as interest rates come down, and we do believe they will come down, and productivity increases with all of the new technologies that we research and focus on in investing all the time. We think the big surprise in the second half of this year is going to be stronger than expected growth, much higher than expected productivity, and therefore lower than expected inflation. Now, the Fed is very concerned about the impact of tariffs on inflation. And yet, if we look at measures like trueflation, which tends to lead the CPI by 45 days, trueflation is down to 1.5%. So the 2 to 3% inflation that we've seen over the last year or so, maybe 18 months, that range we think is going to break to the low side of expectations. So we're much more optimistic about the financial markets in the second half of this year. And in fact, the markets may already be discounting the environment that I just described, because it does seem to have caught a bid here. And it's very interesting to see risk assets, including Bitcoin, take off once again. So with that, Dan?
Thank you, Cathie. We will now begin the question and answer portion of today's webinar. Questions were received from distribution partners, submitted via saytechnologies.com, and sent to our Funds X account at ARK-Funds. All right, Cathie, this first one's for you, and we're staying on the macro economy here. You touched on this a bit at the opening, but what are your thoughts on the Fed's interest rate decision this week to hold rates steady? And then do you expect rate cuts this year?
Yes, I think the Fed is looking at tariffs, wondering how they will impact inflation. We look at tariffs as tax increases and really more of a drag on growth than an increase in inflation. I think the other thing worrying the Fed right now is consumer inflation expectations. If you look at the University of Michigan's index, inflation expectations have gone up dramatically here. We haven't seen this kind of increase since the early 90s. So I think the Fed is mindful of that. I think it's also trying to assert its independence here from the executive branch and really paying attention to the variables that it believes will impact inflation. If we're right, and if trueflation, more important, is right, inflation is going to surprise on the low side of expectations. And yes, we do think the combination of weak economic activity, so negative in the first quarter, potentially negative in the second quarter, given all the really, we're hearing a lot from companies about the paralysis in decision making out there. We may have a negative second quarter. Combine that with lower than expected inflation, and at this level, real rates would be considered exceedingly high. So we do think we'll see a number of interest rate cuts this year.
Great. Thank you, Cathie. Staying high level here, the second question, from an investor's perspective, how do you think about the timing of a potential rebound? And do sort of inflation rates and emerging tariffs still pose a meaningful short to medium term risk, or has the market largely digested that?
Well, I think what's happening right now is we're hearing, at least as of May 9th, some real progress in these trade talks. Markets opening up to U.S. goods that were shut. So non-tariff trade barriers in the UK, in India, and a tariff rate coming down, tariffs on U.S. goods in India coming down from, I think it's 13% to 4%. That's a tax cut. And it should feed into lower inflation as well. So we actually think the market is beginning to discount a rebound in economic activity and this very positive dynamic of a global tax cut, maybe instead of a global tariff increase, a global tax cut. That's a very different scenario than the market was worrying about 6 weeks ago. So I think that's why we've seen the market catch a bid, and we'll see what happens. We know that there's been a lot of seeming chaos around these discussions, and I think that one by one, if we see continued tariff rate cuts and non-tariff trade barriers come down, I think the market's going to continue to react positively.
Yeah, Cathie, and I'll add on to it a little bit too. What we hear you say in the office so much is that just the volatility with innovation, it's really important to average into positions. Sort of as we've seen in all this chaos recently, it's been very helpful for any investors that were slowly legging in. For the next one here, we're going to shift more to companies now. So for the robotics and autonomous team covering Tesla, in the recent earnings calls, what stood out during this call to you?
Sure. So we got a lot of information in this earnings call, but maybe just to highlight a few key points that stood out. First, it was great to hear Elon confirming that he'll be dedicating more time to Tesla starting this month, and also that the low-cost vehicle remains on track for the first half launch this year. But really, in our view, the biggest takeaway was the confirmation that Tesla is on track to launch its robo-taxi service in Austin next month in June. We really think this is going to be a seeing is believing moment for the industry, and in fact, our research suggests that up to 90% of Tesla's enterprise value by 2029 could be as a result of its robo-taxi business. And all credit here to Tasha Keeney, but ARK has been saying for a long time that Tesla's cost and data advantage relative to its peers such as Waymo position it to scale faster and more efficiently than anyone else. So we're very excited to see not only the launch in Austin, but as well as Tesla robotaxis scaling to many cities in the US later this year.
Yeah, and I'll just add some context there. So Waymo launched its first commercial rideshare autonomous in 2018. they just put out a blog post that their fleet has over 1,500 vehicles, and that through the next year, they hope to build 2,000 more vehicles. And Tesla builds roughly 5,000 vehicles a day. So you can see that really they're coming at it from very different angles. And we think that Tesla's solution is going to be massively more scalable once they launch. And then just another, this was a smaller point, but energy storage, continuing to see strong demand and really take off for Tesla.
Yeah, and I'll just add one more thing with credit to Sam and Daniel and Elon echoing this in his recent call. Waymo's cost structure is just way too high for it to scale in a way that will be competitive with Tesla. So he really hammered that home on the last call.
Thank you. I'm looking forward to my autonomous taxi rides this summer. The next one staying here on this team, Daniel, your newsletter on SpaceX and then a tweet about an upcoming model seemed to get a lot of traction on X. I know you can't give it all away, but could you maybe give us like a teaser, kind of what's your high level thinking on SpaceX and how you go about modeling it?
Sure, yeah. And just to clarify, not just me, it was Sam and a lot of people at ARK helped. But we teased our Monte Carlo SpaceX valuation last week, which we've built in collaboration with Mach 33 and currently in the process of finalizing. And to Dan's point, I'd encourage everyone to read the newsletter and the X post we put out, which has a graphical representation of the logic. But I'll do my best to describe it high level now. And essentially, we model SpaceX as a flywheel where they begin with cash. They use that cash to build rockets and satellites. They launch those satellites up to space, which generates additional bandwidth. This then grows the Starlink customer base, which generates additional cash. And they reinvest that resulting cash, and the flywheel continues. As this cycle spins over time, we allocate a portion of cash to Mars research and development up until the point that SpaceX maximizes its constellation. And then at that point, we model SpaceX to go all in on Mars. So how we've modeled Mars is that SpaceX launches rockets with a mix of Optimus and materials. And as Optimus costs decline and productivity increases, we credit SpaceX with the book value of Mars. And throughout the modeling process, we've used Wright's Law, which is core to ARK's research, for various cost declines. And maybe just one interesting tidbit to leave the viewers with is that from modeling it, it appears that satellite performance is the most sensitive input, mainly gigabits per second or bandwidth per kilogram. And this is largely because it has a twofold impact. One, on the top line, it helps determine how much revenue SpaceX can generate, and then also on the capital expenditure element and how much it costs to build the satellites that are going up to orbit. So I would say keep a lookout over the coming weeks as we finalize and ultimately open source our SpaceX valuation model in collaboration with Mach 33.
Thank you, Daniel. And I'll add on here too, for anyone listening and interested in how you can access SpaceX as an investment, please go to ARK's ARK.vc. It's our interval fund for venture products, has it as the top position. Changing to the multi-omic side, plenty going on. But let's start with Guardant Health at Nemo. It was recently added to the ARKK ETF. Could you share with listeners sort of what's your latest thinking here?
Yeah, absolutely. Thank you, Dan. So Guardant Health is in the liquid biopsy space, and it's a diagnostics company. We, have been exposed to this space already through Tempus and Natera, and we have decided to kind of add the Guardant Health to the K, just what we have seen in the last year when it comes to their execution. So, it's number one, Guardant Health liquid biopsy for the therapy selection is the number one in the market. They have also their MRD test, and they are just behind Natera there, and have shown some very interesting data in the breast cancer. And the most recently as well, they got approved for the cancer screening test for the CRC, and this is the first liquid biopsy for the screening. And then they also got, in addition to being FDA approved, they also got the coverage. just a few weeks ago, they have shown the very interesting results for multi-cancer screening tests for the 10 different cancers. We at ARK, we believe that the future in the healthcare is going to be, P4 medicine, where being able to prevent and predict is going to be the keys. And Guardant Health with their kind of approaches kind of fits this mold. And the last thing here that I want to make, Guardant is also putting a lot of efforts in actually collecting all the different data from these tests and actually building the data moat, which they later could leverage, in the either for the drug discovery or to kind of further kind of develop their tests.
One thing I'd like to add, maybe just clarification. Many people hear the phrase liquid biopsy. I don't know why the industry doesn't call it blood tests to screen for cancer or screen for the recurrence of cancer. And then the second thing, MRD, I mean, we're used to talking about it because it's becoming very important, minimal residual disease. That's, again, taking, Guardant has tests, blood tests to check to see if cancer is recurring after, say, chemo or an operation. And these are regular tests that we think are going to transform cancer care.
Great, thank you, Cathie and Nemo. Next here, we have a crypto-related question. So, David, on Bitcoin, we hear uncertainty seems to be like the word of the last month. You hear it at the beginning, inflation rates, tariffs. Bitcoin has shown very surprising strength during this recent market uncertainty and volatility. What do you think is driving that?
Well, to provide some context for listeners, Bitcoin is up 14% in April. But on top of that, against USD, Bitcoin is up nearly 40% from the April lows as of the time of recording. And perhaps more interestingly, against the S&P 500, if you make a ratio of Bitcoin and the S&P, Bitcoin is up nearly 36% since the February lows. So already anticipating a lot of the tariff situation. And it's almost breaking its all-time high pretty much right about now. We're recording this on Friday, May 9th. So very interesting to see, especially its strength against equities broadly. We believe this is generated by two factors, perhaps. One is, to some extent, Bitcoin is already considered a kind of risk-on asset, and it tends to lead the general market. We believe it was already pricing in a lot of the factors related to that post-tariff scare that were setting place during April. But on top of that, it showed a lot of strength again against the S&P, which was very interesting. I think Bitcoin is already kind of like anticipating a lot of the value proposition to mainstream investors, which is the store of value qualities it has. So I think we're kind of seeing a mixture of both that mercurial quality that Bitcoin has in terms of being risk on and risk off, depending on the very specific situation, which is good to see because that's ultimately what you want in terms of lack of correlation with other assets. To add, I'll just say that Bitcoin also had the largest net inflow in terms of ETF supply on the week of the 18th, I believe, marking about 29,000, 30,000 Bitcoin increase across the multiple ETF issuers, proving pretty much that most of that demand came from that U.S. institutional investor.
Yeah, and David, maybe just your on-chain analysis and some of the recent findings, maybe you can reinforce those. I found our discussion yesterday about entropy, which is maybe a little too much to get into now. But the surprise is how little Bitcoin corrected relative to past corrections, and how there might be just this underlying demand there that many people don't appreciate, especially through what seemed to be a very chaotic situation around the tariffs.
Yeah, to provide some additional context to listeners, in past bull cycles, let's say 2016 or 17, when Bitcoin was more of a retail asset, 50% corrections, even within bull markets, were pretty common or relatively common. So we're very interested in seeing that in this cycle, Bitcoin has yet to go lower than a 30% correction. This is and it's also keeping with a market structure that is, like, let's say, quite much less chaotic compared to the past. The expectation from this, or the cause of this, we believe, is it comes just from the fact that institutional investors who seem to be driving price discovery these days are just more a different type of investor, which is basically driving a way up, taking profits more diligently, and then from those profits, perhaps providing liquidity at the bottoms, and reducing volatility over time, pretty much.
Thank you, David. And for those listening that are interested in following along with updates monthly for these on-chain analytics, David and the crypto team publish a Bitcoin monthly paper that you can find on our website. Staying here in crypto, Lorenzo, we're going to come to you next. So ARK does not hold any of the Bitcoin mining stocks, but very bullish on Bitcoin in general, as you just heard from David. What's the reasoning behind this?
Yeah, it's a very good question. So maybe to explain a bit the miner economics, miners are key actors in the Bitcoin supply chain. They secure the network by basically running algorithms with machines that we call ASICs, and they do this in huge data centers. So very similar to AI in some way, with the hardware that is a bit different. And they basically secure the network and receive Bitcoin as rewards for doing that work. And those rewards are usually proportional to the hash rate, which is the compute power that they're willing to allocate to the network, right? I think historically, this is a business where they have huge capex cycles, right? They need to buy the hardware sometimes 6, 12, 18 months in advance, in a supply chain that is extremely centralized, and most of the ASIC machines are developed by Bitmain. Now we have a few players, MicroBT, Canon, there's a few in the US, but with the pricing power that is very much monopolistic and very, very opaque. And so, it's a business that is very, very capex intensive, and with cycles, obviously, with Bitcoin's volatility, because the revenue that they get is, directly tied to the Bitcoin price, right? And so when you think about that, you have to buy machines that are priced, in actual Bitcoin terms, for rewards or revenue that you're going to get perhaps, in 18 or 20 months. And so it's very, very difficult as a business. On the cost side, on the electricity, and we've been talking to a lot of miners. The cost is obviously, cost of electricity is very much a commodity right now. They're all deployed in the kind of the best jurisdictions, and so this is something where they can't really increase margins by decreasing their cost of electricity. And it's a business. The miners are usually highly levered on the upside and also on the downside. And so if you look at an asset like Bitcoin that already has a lot of volatility, a lot of these miners, when we have a downturn, in terms of the stock price, obviously goes down even more than Bitcoin. And many of those either go bankrupt or they need to be acquired or they need to shut down the machines. And so I think from ARK's perspective, we're very much focused on scalable innovation platforms. And I think for digital assets and Bitcoin, we would rather have exposure to more the software infrastructure and layer of this. And so we always have to think of what is, we hold Bitcoin and we hold many equities that give us exposure to digital asset in many other ways that is not mining. And so the risk adjusted return comparatively to holding, just Bitcoin has not been there like in the last years, right? And so that's one of the main reasons. We can also talk about regulatory risks. A lot of the miners, there's a lot of ESG and environmental pressure in Europe. They obviously consume a lot of electricity. We've seen mining being banned in China, in Norway with some laws, and so it's a very, very difficult business that ultimately is closer to a power or utility company than that Bitcoin, the pure asset, and more of a software play. And that's why typically we haven't really invested in miners. But we look at the different players very regularly, and we might change our opinion. But I think given what I said, having exposure to Bitcoin or other stacks of the Bitcoin supply chain makes more sense for us.
Thanks, Lorenzo. That makes sense and it's very helpful, nuanced take there. We're going to jump back to the multi-omic space here and just healthcare and the regulatory framework that's evolving in general. There's a lot going on this week, and since the new administration took over, seems like the market tends to react really volatile to any sort of appointments. And this week there were a few notable ones, including the head of the Center for Biologics Evaluation and Research and the FDA's first chief AI officer. Nemo, can you give us as much detail as you can on sort of these impacts so listeners can understand what's going on?
Yes, happy to. So I would say, both of these appointments mark a significant step forward in healthcare innovation, especially that we are getting the first chief AI officer. And so the chief AI officer will play a crucial role in integrating AI tools within the FDA review process. And, yesterday I listened to the FDA Commissioner McCarry, who said, I didn't want us just to talk about using the AI. I wanted us to start using AI as soon as possible. And yesterday there was also a news that basically they announced that they have finished a pilot on using the generative AI for the review process, which kind of help them, something that would take usually a 3-day person to review, to do it now in about 6 minutes. They want to switch, for the using the generative AI in the review by the end of the June. But also, Macari said in the interview, this is just the beginning. They really think that if the, AI can do any routine processes, systemize the data, review the stuff, and just then allow the reviewers actually to think about the science. So we really think this can revolutionize how quickly and effectively new therapies are being evaluated and approved, and also potentially accelerating the access to life-saving treatments. And for the CBER director appointment, we think that this is gonna bring really transparency and the rigorous kind of science to the front in actually evaluating biologics and cell and especially cell and gene therapies. We kind of in the long run, we definitely think that this was the right pick. That this will push the industry to actually really deliver innovative treatments which are actually curing the diseases versus just managing kind of chronic conditions. So overall, I would say that these are really great developments. Again, it's all about data-driven transparency and doing what's best for the patients.
And I'll just add here, we really do believe that the most profound applications of AI are going to take place in healthcare. And just listening to the video, I would recommend anybody interested tune into the video. The head of the FDA, Makari, and the new head of the CBER, Vinay Prasad, were in conversation. I think they wanted to clear up the confusion. A lot of people assume that Prasad's going to stop innovation because he thinks that some studies out there haven't been well constructed and so forth. But he disabused, I think, the listeners of that. And the other thing that happened this week was RFK came out and basically talked about gene editing, which was a fear that Prasad would want to shut down gene therapies, gene editing, because of his position on a company called Sarepta. But that's not true at all. Getting us away from chronic disease into cures is where the entire administration is focused. And Robert F. Kennedy himself mentioned sickle cell disease, which is the indication that CRISPR has focused on with Casgevy, CRISPR and Vertex. So I think we've got a very progressive administration here, bringing AI not only into trials and diagnostic testing and therapies, research generally, but also into the government to streamline and speed up the progress towards new drugs, new therapies, new ways of doing things.
Just to kind of add here, obviously in the current kind of process, there is a lot of inefficiencies where AI can help us. And I think, everyone is using ChatGPT for different things in their jobs, right? And you can see how AI can be helpful, systemize the data, do some mundane tasks much, much faster, right? But in my mind, this is just a kind of first layer. I'm just going to be here kind of, but visionary. Can we see that in like 10 years, the FDA is completely reimagined? Where there's like a foundational model and where AI is actually reviewing the drugs much faster than the reviewers that are doing now. Obviously, we always need to have a human in the loop, but I'm just thinking that, this is just this is the right way to go because, this is a starting point and there is much more to be kind of built on.
A couple more underlines here too. Vertex on Casgevy, Vertex and CRISPR announced their earnings this week, and accelerating treatment centers coming online, accelerating patients, collecting cells, and then demand in the pipeline as well. And Nemo also, I just want to underline those numbers you said, like reviews decreasing from 3 days to 6 minutes with AI. I mean, that's crazy. That's the productivity boom that Cathie was talking about at the beginning of this call.
And the one thing here is that one of the huge problems with review process, there is not enough reviewers. And then each reviewer has to do a lot of reading and systematizing stuff before they actually go to actual science and actually make decision. So all of this can, can be done with AI for them in advance. And then they are just like thinking about the science, and kind of, deciding there what they need to do.
And the other interesting point that Makari made was he's excited because the talent at the FDA is enjoying what it does on a day-to-day basis instead of all of this paperwork, actually getting down to the science, which is why they joined the FDA in the first place.
Great. That's a good one. It's an exciting way to end this here too. It's good final question. That concludes today's webinar. So we will briefly show some performance statistics that can also be found on ark-funds.com. Thank you to everyone who listened to today's call, and thank you to the entire ARK team.